Hi, I'm John from Metro Finance. We work in the shared ownership mortgage sector, but this applies to any type of mortgage that you may be about to apply for. Mortgages and what can often be the pain or the fear of applying for them, the fear of being rejected by a mortgage lender. I've got 5 minutes to try to give you a few tips on what might increase your chances with a mortgage lender. So the first one, who lives at your house? This is super important because on day one, the lender's going to do a credit search on you. And what they want to see is you on the voters roll and you living at that account. So that means your bank statements, your loans, your credit cards are registered to you at that address. One of the bad things that a lender can see is that the voters roll with the previous occupants still on there, which then makes it appear that you don't live there. So that's number one, and it's absolutely key. Next is who's taking all the risk. Now, a lender or a bank or a building society, they don't want to be the one that feels like that they're taking all the risk, that they're putting all the money in. The more risk the lender takes, the harder it's going to be to get the mortgage. Now, yes, you can put down the smallest deposit possible. You can put down 5% of the share on shared ownership. But if you can stretch to more, say 10%, then do so, because not only will it better your interest rate, it will lower the mortgage balance, it will increase your chances of getting a mortgage. How do you look? Now, I don't mean how do you look in the mirror, because you probably look great. I mean, how do you look on paper? How do you look digitally? Get your credit file. The one I would use is Check My File, because that incorporates all the main credit reference agencies into one file. And you're looking at things like we just said, the voters roll. You're looking at all your credit accounts, your cards, your loans, your car finance, making sure that all the payment profile that it shows is actually correct, all the actual amounts are correct. If there are any missed payments on that you didn't miss, those need correcting. Get in touch with the credit companies that made the mistakes, get them to fix it. If you have no joy, then go directly to Equifax or Experian or whoever the credit reference agency is and get them to help you to fix it. No score. So let's say you've got your credit file and it shows very poor credit score or no score at all. Don't worry. There are plenty of lenders out there, and it's mainly the building society type lenders, those regional lenders, that will help here, because often they don't credit score. They're still going to do a credit search on you, but what they do instead of the scoring to make a decision, they will look at a picture of you from your credit file, from your pay slips, from your bank statements to make a lending decision. Now, yes, you might pay a small premium on interest rates, but not as perhaps they used to be termed subprime rates. Those days are gone. This is high street lending. I suppose the only downside is that this type of lender might be a little bit slower than a digital lender, but that's understandable because they're taking that more human underwriting approach. Boring bank statements. Now, if you only listen to 2 points I'm making here, number one would be the credit files, making sure it's all accurate, up to date and correct. Number two is the boring bank statements. Most lenders are going to want the last 3 months bank statements, and even if they don't ask for it on day one, they could ask for it midway through the process. Now, ideally, you would be Mr. or Mrs. Perfect, never overdrawn, your income lands each month at the same time, you don't spend all your income each month, there would be no gambling on your bank statements, and you wouldn't be spending £800 a month in, say, McDonald's. Now, that's totally unrealistic. So the goal is to get as close to that picture as possible. And I suppose the opposite end of the spectrum would be living in an overdraft, even going over the overdraft, betting on sports every day. That's not really going to help you get a mortgage. You want to be as close to out of overdraft as you possibly can, with good spending habits, no missed payments on your bank statements, a nice, clear, clean looking last 3 months. Understand your income. Now, this applies to employed people, self-employed and contractors. It may sound odd because it's your income, but to get the most out of a mortgage lender, to get the best interest rates, to get the amount you want to borrow, the income has got to be keyed correctly to the lender to make that happen. You've got to know every penny what's yours. Now you've got your things like your overtime, your antisocial hours, your bonuses, and often these can be called different things by different employers, and can be paid at different times of the year, quarterly, monthly, bi-weekly. So you've got to understand it so that you can explain it to the mortgage lender directly, or to the mortgage advisor or broker, so that it helps you. Speak to a mortgage advisor. Obviously, I'm bound to say that. I work for a mortgage advice firm, and despite the picture of the wise old owl, I'm not wise. Most mortgage advisors aren't wise, but what they do know a lot about is the very boring subject of mortgages. And if you take, just for example, shared ownership, it has 300 different mortgage products. And obviously, you're only going to take one of those, so it has to be right. It's a massive commitment. Get some help. That's all I would say. Finally, apart from thank you for listening, just remember that the key is presentation. It doesn't matter what you really like or what you look like in the mirror. It's about how you look on paper. That's what matters to a lender. Thank you.